We'll get started here at 12 o'clock. I wanted to thank everyone for joining us here on our weekly Lunch and Learn. This particular topic will be sourcing a deal, and we'll talk about how we choose partners, projects, and put together an investment. A quick intro. My name is Neil Wahlgren. I'm the COO here at Wilson Investment Properties. I handle strategic partnerships, acquisitions, underwriting, and really everything that goes into putting together a deal and offering it to our investor base. And we'll be talking a little bit about how we do that, partnerships, etc. I've been with Wilson Investment Properties 3 years now, the background in personal finance, joint ventures, and then eventually military aviation prior to that. All right, let's talk a little bit about how we pick our partners and why. So the way Wilson Investment Properties is structured is we are an investment management service provider, marketing arm, and we provide high quality real estate commercial investments to those investors. When it comes to choosing the assets that we end up putting together a deal around, we always leverage partners and the expertise that they bring. The advantages of this is that we're able to lower the project risk of all the deals that we put together. And what we do is we bring on partnerships onto the sponsor team, and we bring on individuals and companies that have specific expertise in the type of deals we're doing. So for example, we're closing out the raise on a multifamily in Atlanta, partnered with a group that had not only had experience in buying and successfully managing multifamily assets in Atlanta, but had also done that submarket. They knew Class B multifamily extremely well, and they have multiple decades of experience and a proven track record. Those are the type of partners that we put together. And so what we try to do is have a small amount of reliable partners that we can do repeat deals with. And that allows us and our investor base to build trust within that partnership and build trust in terms of repeat investment with the same groups of sponsors that are putting these deals together. It also allows us to do more control. So we like to bring in partners that allow us internally to have commercial brokers on the team, and also, whenever possible, partners who own commercial property management, so that we're able to have direct control and hands-on control of that property management aspect of the real estate assets that we're buying. Most of these partners are introduced to us through co-investment, business, personal relationships, and we always conduct the required due diligence and the legal protections to make sure that we bring them on in a manner that is provides protection to both us and our investor base. All right, let's talk a little bit about how we choose properties and submarkets. Data. So the way Wilson Investment Properties has been founded and how we continue is we always do a data-driven approach when looking at both the asset and the submarket before we go forth and present a deal. One of the hugest things is understanding that submarkets are often different than markets, and markets are often different than national data. So when you hear about, industrial, for instance, doing well, or multifamily being overpriced, all those often are true on a national level. But then when you start looking at, MSAs and start looking at submarkets, oftentimes that story gets better or worse, and that's what we look at. And the underlying issue that we look at for data is growth. So we want to look at trends, unemployment, jobs, GDP, and population. How is this metro moving? Is it getting stronger or is it getting worse? And that's ultimately, we want to buy assets in areas that are improving. When more people are moving to an area than leaving, when more jobs are being created than being lost, and when unemployment is decreasing, those are good, solid economic trends that bode well for long-term holds of real estate investments. And that's what we look for. We also look for relative risk. We combine it and compare it with other metros that we have a possibility of investing, other submarkets, and other assets within those submarkets. And we like to bring on and move forward on assets that have lower relative risk compared to the competition there. And lastly, we're prepared to walk away. So we take really an emotionless view. I have to be proven yes. I'm spring-loaded to no on any deal that I look for. And I have to basically convince myself based on the data that this is both an asset type and a submarket type that we want to press forward on. And lastly, we'll talk real quickly about investor appetite. So when I handle acquisitions and when I'm putting these deals together, I'm balancing both the quality of the deal and the submarket with the appetite of our investor base. Because if we can't raise the equity, then the deal will fail and we'll never acquire it and never move forward. So what we try to do is provide a diversified take on the type of assets that we're offering to our investors. So what I try to do handling acquisitions is provide a balance between stabilized, cash flowing, lower risk deals. And we seek, if the deal is cash flowing, we try to put together between 6 and 8% preferred returns. And what that allows us to do is that allows us to lower the relative risk going to the investor base. And that ultimately it lowers the risk to the investor base because it gives the investors the top priority for incoming cash flow until we cross those preferred return thresholds. We also look to minimize load. So we do that through minimizing upfront fees and maximizing the amount of sponsor revenue that comes on the back end. And what that allows us to do is to align our incentives with those of investors. And ultimately, that's one of the biggest things that we try to do is balance where our compensation comes from and where an investor compensation comes from. And as long as those are aligned in such a way that we're equally motivated to manage the deal successfully through and exit at a profit, then I feel like I've put together a good deal and hopefully investors do as well. And those tend to be our most successful offerings and raises. And lastly, we diversify our investment type. So some we provide that higher minimums that are available for accredited investors only, more seasoned investors, and those might be more complex or longer term, lower cash flowing deals. And other ones, we do lower minimums, open to both accredited and non-accredited investors. And those allow us to get more transitionary investors, for example, those with single family home investment experience only, to be able to come in as well. So at this point, we will switch over to our Q&A. Again, I apologize about the quick break there, but we'll go ahead and take questions. And you can go ahead and type in the chat box and we'll answer as much as we can. All right, so one question here. Ballpark-wise, how many deals do we need to weed out before finding a suitable one? What are the numbers and types, industrial, commercial, office, multifamily? So we leverage our partners. And what we do is those partners probably weed out, take 20 deals and weed them down to one that they think is good for our partnership based on our criteria. And of those, we probably do full underwriting and look at between 5 and 8 deals that were pre-screened down to our criteria before we have one that may work. And then we have to go through lending. Then we look at the demographics. And between those, we probably weed out another 60, 70%. So ultimately, from the top-down funnel with our partners, we're probably looking at about 200 to 250 deals for every one that we actually put together and offer. And in terms of what numbers and types, I would say it's about an equal mix between industrial, commercial, office, and multifam in terms of what makes it through the funnel, because we try to provide that balance and diversity. All right, here's the question. So most of the time, is it your partner that brings the deal to you as opposed to you finding the deal and looking for a partner with expertise in that area? So almost always, it's our partner who brings the deal to us. Our expertise is not weeding through tons of deals. Our expertise is bringing on the right partners with that expertise to do it. So what they're able to do is use their discernment and experience to narrow that down. And once they have something that they feel meets high quality asset in a high quality area, then we kind of bridge the gap between what could be a potentially good investment and the appetite of our investors. And then we basically put it through a few filters of risk. And if it's able to connect those two dots, then that's something that we say, hey, this is a good partnership to move forward on and offer out to our investors. There's a question: with the recent jitteriness in the equity market and the highly anticipated market correction, what's your perspective on impact to the real estate market? i.e. any correlation between equity and real estate cycle. So it's a great question. Every deal we buy, we intend to hold long term. And what we try to do to insulate amongst upcoming recessionary events is to really have a deal that's in a high growth market. So again, if an area is in a high growth trajectory, historically and statistically, it's far more likely to weather the recession better than an overinflated or overpriced market. To use an example, Houston, in the last crash, housing prices dropped 6%. Vegas dropped over 55%. So the difference on those two was because Houston was in a high growth market with jobs, GDP, and solid economics. Vegas was not. And so really, we look for similar type of attributes that Dallas or Houston had versus Vegas. And we also look for insulated on the debt piece. So when possible, we like to have fixed rate debt that'll allow us to potentially hold for another couple of years if necessary without being subject to the risks that come with a fluctuating debt market. All right, we'll stay on for another 2 minutes if anyone has questions. All right, here's a question. Are you looking at any opportunities in the new opportunity zones created in the 2017 tax law? That's a great question. We have looked. We have not currently moved forward on putting together one of the funds that's required to fully take advantage of the opportunity zones. However, if we are able to acquire an asset within those opportunity zones, we have the option of rolling that into a fund down the road, which would be beneficial to the investor base that have ownership in that type of deal. Most of what we've looked at so far tends to be not in opportunity zones, and deals that are in opportunity zones tend to be below our general quality metrics. So what we're trying to do is hopefully find that happy medium of a deal that has intrinsic quality in a good metro, while still being an opportunity zone. So far, we have not been able to identify an asset that meets all those criteria. And ultimately, while tax incentives and opportunity zones are nice, at the end of the day, we look for high quality, low risk metrics at a higher priority than we do opportunity zones. All right, we'll stay on 1 more minute if anyone has any questions. Okay, well, this will wrap up the presentation here. I want to thank you all for attending our first Lunch and Learn. Any follow-on questions you have, you can reach out direct to the office, info@tomwilsonproperties.com or 408-867-1867, and we're happy to answer any questions that you have. Thanks again for joining us, and we'll let you get back to your days. Take care.